So stocks fell today and started the journey down to retesting the lows. The widely expected and heavily crowded trade of retesting the lows today. The question is whether or not today was an April Fool's joke or not. So I'm going to break down today's bearish move to see how bearish it was and what we can expect to see by the end of the week going into next week based on some of the technical signs that today produced. We're going to talk about kind of what fell during this past couple days of pullback and what's led us down and how significant that is in terms of whether or not we are increasing or decreasing in our risk aversion or risk appetite. So we're going to break all that down from a technical perspective. Our trade idea is going to be a high probability bearish trade with this high probability bearish expectation that we all have, that everybody has, to be able to help us take advantage of it in a very short-term trade with a trade that's pretty tough to do. So we're going to talk about that and how to do that. So let's go ahead and get started. Today is Wednesday, April the 1st, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the market forecast indicator with the S&P 500. You can see the S&P rolled over today, closed below. In fact, if you kind of break this down, today we've had 3 down days and 4. So keep that in mind. That's kind of interesting. It wouldn't seem that bad, but we've had 3 days out of 4 to the downside. Essentially, this 4-day streak here with the 3 down days pretty much erased the gains on March the 26th. So we had that big up day on March 26th there. That was a Thursday. Big update. We closed March 25th at 2475.56. Well, we're at 2470.50. So we're down about 5 points into that little body we had on that Wednesday on the 25th. So essentially, what, a week ago? Exactly a week ago. So a week from last Wednesday, we've gone nowhere. We've gone up and we came back down, and that's it. And you can see the gap that we formed here. Of course, as mentioned before, we got another band of dark pink shading. We get lots of bands, lots of changes between dark pink and light green, and as you can tell here, when I go back out further, there can be a lot of changes here between. You can see you get some more longer changes, and they get really frequent as you've been in it for a while. You can see a couple of big long pink ones, bigger pink ones here, pink and light and green in between in that area. Of course, again taking a look back at 2008 to 2009. Again, dark pink shading, a little brief light pinks, dark pink. So we'll kind of keep our eyes on this and see how long this dark pink shading will last. You can see that's, these kind of longer ones had the intermediate line falling into the reversal zone after. And if, we do that again here on the S&P 500, then, that means, again, retesting these lows, right? That's kind of the idea. We'll get dark pink shading for a while and retest those lows. But as you can see, sometimes the dark pink shading is very brief. You bounce up, you get dark pink, you go up a little bit more, you get, then you kind of retest those lows again. So don't be surprised if we don't get something like that where we get light green again, because we are relatively higher in the higher up above 20. It's not like we're going to fall right back below 20 here. At least in a day or two. It's going to take a few days to get back down, because remember, we're not going to fall as fast as we did here, which brought the intermediate line down. After this point, we bounced up here, and that got us back up to 30. So from that point all the way back down, was this point here, from that high to that low, and then of course to that low we really broke down below 20. I mean, that's the kind of drop that got us back below 20. We're probably not going to get that type of drop again this go around. We're not in that type of market mode anymore. In fact, you can tell the momentum line here on the rollover. You can see on the rollover here, the momentum line started small, got really big. Right now, we're kind of starting small again. Where the momentum, like the last momentum drop we had, it's not as extreme to the downside as the last few momentum lines levels we've gotten here. So, and then the near term line after getting this bullish, relatively bullish high, because it was still a lower high compared to the last near term peak. That was the last near term peak. This is the current near term peak. Now the question is, where is the next near term low point going to be? We're down below 50, but we're still above 20, and we're still higher than that low. I mean, there's a good chance we can form at a bullish near term low point on here. Now again, not to say that we're going to like take off from here, right? But if you take a look here, just in one day, do I not have it on? I don't. Usually have that on there. Here we go. So just right to that low point up to that high point. You can see we've come all the way down 38% retracement already. That of this bullish move, we've already hit the 38% retracement. You can see where the midpoint is and the bottom of this retracement zone at 2350 is. So on a short-term basis, you can kind of see, there's some support here on a very short-term basis, like in terms of like tomorrow, that short-term of a basis. You can also see too, the gap that we have that can easily be filled in, because again, common gap that can be filled in the short-term basis. It would have been more bearish had we spent most of this down day to the downside, but you consider, we lost 114 points today, but the range was only 75. In fact, if you look between the open and the close, 24.98 to 24.70, we only lost 28 points from the open. So out of 114 points being down, 28 of it occurred during the market session. The rest of that, however many, a lot more than 28 points occurred overnight on extremely light volume. It would have been a lot more bearish had most of the 114 point drop occurred during the regular trading session on more volume, but it didn't. So that's something to keep in mind in terms of how bearish we are here. The Russell 2000 was a lot more bearish. It did have most of its drop. You can see from the open today down to the close, we were down, 27 plus another 28, so or 29 roughly, 28 plus the 27, so about 56 points out of 81 occurred during the market session. So a lot more bearish there. Its momentum line fell more, but still didn't get to extreme lows. Its near-term line also fell below 50, but not to oversold territory either. And you can see also kind of the retracement zone that it would be hitting here, probably closer to the 50% mark. And you can see the potential for if we were to bounce right back up in the very short term and produce another line of light green shading, that might be a very again, you got a lot of people thinking that, okay, here we go, retesting the lows. And again, when that bandwagon gets really full, and there's a lot more full now than it was a couple of days ago in our last market outlook video, then again, look for fake out moves that you can get to knock those bandwagoners off. Now, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells us two things. Number one, you liked our video today. And number two, you want us to do it again tomorrow. And that's how we see how people like our videos or not. Again, if that's the case, one click you can do right now. If that's not the case, then you don't have to click anything down there. Also, while you're down there, comment. What did you get out of the video today? Love to see like the one thing that stood out to you from today's video, whether it's a comment or a question or anything. Let me know in the comment section. Join our website at marketscholars.com. There's a link popping up right there in the top right corner of your screen. Click on that link so it takes you to a page where you can subscribe to our site for free. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our website here, we also invite you to check out some of these things that are over here. You can see we have our class schedule over here on the right. View more will take you to the page. Actually, this page, if you click on Trading Rooms, you can see all of our classes. All of our monthly subscribers get access, well, all of our subscribers, but our monthly subscribers get access to all of our trading rooms. Our premium subscribers also get these weekly Q&A sessions, kind of online coaching sessions. So check those out there. We also have this Market Outlook Live. I've already put today's trade idea on. and on the video that you'll see later at the end. We did it before the market closed at 3:30 Eastern time during this video. So if you want access to that, monthly subscribers and premium subscribers also get access to those videos. So check that out. We also invite you to engage with us here. Click this heart. It opens up this window. You can like that Market Outlook tweet. Click the thumbs up. It lets you, you can like today's Market Outlook Facebook post. Again, the more you engage with us on those social media platforms, the more they will promote our content to you. They out of all the accounts you follow, they promote the content to you first that you engage with the most. We try to make it really easy for you to engage with us here. Now, if we go back to the charts here, we take a look at the long-term chart. I mentioned in the last Market Outlook video the fact that we would get, that we've got the opportunity here, the likelihood for a small body with a long upper and lower shadow for that matter. I mean, that's a pretty transition candle. Now, granted, we're still way below the 50-day moving average. And a lot of times we might just get back up to the 50-day moving average with this type of move. So again, another reason why, you might just check and, just keep an eye that we might jump up a little bit. And again, it might be a week or two, but the 50-day moving average is going to be a lot lower by the time we get down to, by the time we would get up to that area, excuse me. I mean, it's at 2,800 even, which would be 280 roughly on SPY. We might get there just in another, who knows, by the end of the week, if we were to make a quick move to the upside. But it kind of shows you, just how maybe not bearish we are, as bad as today was, considering the type of pattern that we're seeing here. And just to give you an idea, for us to be really bearish again, if this is how this week ends up or pretty close, we would have to close next week's Hakinyashi candle below this low point for us to be really significantly bearish again. And that's 2458 or 2447 is the low point there. So to kind of give you an idea of where that is, 2447. It'd be right into, like, we'd have to, was it 2447? Right, 2447 there. To kind of give you an idea of, we're at 2470 right now, so that's not very far away. So we might close below 2447 this week, but it would kind of give you an idea, wherever the low ends up being this week, that, in fact, that's today's low point. Wherever the low ends up being this week, we'd have to close below that on the Hakinyashi candle for us to really be bearish again. So keep that in mind there. Let's take a look at the 3 green arrow charts. You can see, here's another thing about today's drop. Like, as bearish as it was, 4.5%. How many times can you say that we had below average? Like, here you can see the close 257.75, the high 257.66. So we pretty much, at least according to that, pretty much filled in its high point on SPY there. So, slightly lower range, and really that's, where did that move? 25.57. There we go. So it was up 251. I don't think we got up to 257. So I think it's kind of using that print. In fact, it is using that print. The highest point that we actually got to today was not that. But in fact, let's kind of take a look here. Here we go. So without that kind of extended hours trading there, we're looking at 251 was our high point, and 243 was our low. So about 8 points there. You can see the open was at 247.98 and the close at 246.12. So we had a very, very small range. Very small range. So most of the loss occurred overnight, as you can see. And again, if you go from the close over here at 257.96, 257.70, excuse me, up to this high point, 251.44. So that's about 6 points of range added on to this range here. Let's just jump this up to like 2 hours. So the range today was 251.44 down to the low of 243.90. So you're looking at 7.5 points of range intraday, and then you have to add on the gap here between the close at 257.70 and then the high at 251.44. So another 6 points. You add that in, recall. We had 13.8, so pretty close to the daily range with that one kind of bad print that almost got us up there. And so the actual range, including the overnight drop, was actually below average, slightly, but below average. So how interesting is it that we had a down day today, a 4.5 point drop that was on below average volume and below average trading range, considering that all of our other drops have been so big lately, as bad as things were. So that kind of puts in the context how bad things actually were today. Let's take a look at the intraday chart, and you can see right there that there's our gap. And again, that's not a break, that's not a runaway gap. We're not starting at, we didn't have a bullish intermediate run here. The intermediate line didn't even get above 50, much less have a multi-month intermediate run. So this isn't necessarily a runaway gap. It's also not a breakaway gap. We're not breaking through any significant low point here, and we're not, especially just as we just mentioned, not doing it on an increase in volume. So it makes it this more likely that this is a common gap, which means there's a good chance that we can fill that gap in relatively quickly as tomorrow or Thursday or by the end of the week or next week, right? It's very good chance that we can fill that in before, and you can see where kind of some support would be if we were to continue down, like this little downward move that we've had. We bounce up, when are we gonna, how do we know from a technical standpoint there's a good chance that we're gonna roll over and continue down to potentially a lower low from this lower high? Well, once we break that down below this little volume node. In fact, that's something I showed today in our options inventory class. It's a good time during this quarantine to be watching, like to spend some time watching these types of videos. We do a trading room every day. So for our free subscribers, we'll send out something here later today or tonight that will, that can kind of give you an idea of what we do at Market Scholars here. Let me just quickly show you. If you go to our website, to get that link here tonight, again, all you have to do is be a free subscriber. You can click right up here, this little blue button takes you to that same page. Anywhere on our site, and you can subscribe for free. And like I said, we'll kind of send something out today to kind of give you an idea of the classes that we do. But considering that we're all inside right now, is a good time to watch some of these classes. And I spent quite a bit of time talking about the technical charts today, of how things are going to look like if we do roll over, and how likely we are to come back up in the next maybe day or two and fill up not only that gap here on the price level, but also that gap on the volume level. Of course, when you look at that volume again, the average price, the average, the trading range a little bit below the average of 14 points, and the volume well below the average. So again, as these continue to come down, that's a good sign. It doesn't mean that we won't retest these lows, but it means that we're not going to have the same selling pressure that we've had before. And remember too that we don't get a low point. Like, we won't form the low point until we're closer down to this 3% mark. So we still got a lot of choppiness to go. Whether it's a one-day chop like maybe today was, maybe, whether it's going to be a up and down like, a 5-day chop where we essentially were flat despite some pretty big up and down moves during the past 5 days. There's going to be some choppiness, either in either direction, up or down. And of course, as we do go down, you see on a Bollinger Band level, you can see where, we still got this volume gap right there, but you've got a node starting to form at this point. There's very little volume below us on the 1-year chart, but if we do go down to lower lows, again, that 210 or 2100 on SPX, very, very important level. Something to also keep in mind about today's little jump or drop here, the negative directional index jumped back above 25, but you can see it's on a steady decline too. So it's not like we're going to jump back up to 30 or 40, most likely. So that's why these ups and downs can be really brief, and we can start getting a lot of choppiness. It doesn't mean that we won't rally, doesn't mean that we won't trend lower, but it's going to be some frequent ups and downs in between here. It's not like when you're dark green where you just go up and up and up at a slow grinding pace day after day after day practically. Finally, I want to take a look at the volatility index, which is another topic we talked about. And again, as we drop back down, you notice that, we've had a little bit of a jump in the volatility, but we're still dropping on a relative basis. So again, another reason why it's going to be hard for this to go up too much, the VIX that is, because we're so elevated still. I mean, we're over 110%. The VIX is over VXV. That's a relatively elevated number. It's, the VIX can jump up to get to these levels, but you notice we're not jumping up anymore. We've come off these lows, but now we're, the VXV, the VIX 3-month is starting to settle down a little bit. And as it settles down, you'll see the VIX start to settle down along with it. And in fact, if you look at today's candle, you can see that it really wasn't that bullish of a candle. You can see it's rare for it to get too bullish of a candle. It's in fact more often than not we come off of the highs, even on the up days, like something like this where we were up but we were well off the highs. So and you can see we're in the mode right now of getting more filled in candles than we are open candles. So if that continues to be the case and we continue to trend towards 50 on this, expect some more filled in candles, which will more likely mean, even if we gap up to the upside, that we fall in volatility throughout the day by the time we get done. All right, so before we talk about what's driving this price action, just a quick technical summary of the charts we just looked at. So a down day today, looking like the bandwagon's headed in the direction of retesting the lows, picking up more people along the way. The question is how bearish we actually were today relative to what we've been in the past, and whether we're likely to, whether today was like an April Fool's Day, and we reverse it really quickly. So just be aware of that potential of reversing today's drop and filling in some gaps here in the next couple of days, kind of a big April Fool's joke to all the low retesters, and then ultimately retesting the lows. Or again, the higher probability outlook is we just continue to drop. So we've been in our classes at Market Scholars, at least in my active trading class with options, we're prepared for us to retest these lows. But, if we were to fake out in the next few days, that's okay too, with the risk that we have. But we're more than prepared if the high probability scenario plays out, as well as you should be too. But just be open to the potential of a short-term, very short-term rally in the next couple of days to kind of give us the April Fool's joke for today's drop. So what do you think? Do you agree with that? Disagree? There's a link, a link popping up right there. Click on that. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that would suggest either you're a lot more bullish or more bearish than what I just painted with our technical review there. All right, now back to the charts, and you'll see that you have, let's talk about what's driving this price action. So let's go to here and take a look at today. It was an interesting move today. If you look at the asset class comparison chart and just look at today, and look at this little bounce that we've had. Like from the bounce off these lows, bonds and gold have been rallying while equities have been rallying too. So, and really from that December, from that 323 low point, we rallied 324, right? So if I were to go from 324 to now, and just take a look at how things moved, you can see preferred stocks rallied up, real estate stocks rallied up. They're still, from that low point, real estate stocks, as bad as they had today, are still the outperformer. They pulled back a lot in the last couple of days because they had a lot to pull back. They had such a big outperformance when we were at the peak. In fact, if you take a look at just the last couple of days, so 331 and then today alone, that was the biggest loser. Well, there's a reason why it was the biggest loser, because previous to that, it was by far the biggest winner up until the end of Monday. So that's one big reason that to go up 25 in 4 days, Tuesday, Wednesday, Thursday, Friday, and then Monday, 5 days. To go up 25% in 5 days and be the best asset class performer, that's not a common occurrence for that particular asset class. And so, and even with its big pullback in the last couple of days, it's still the best asset. It's still the best asset class off of that 323 low point. So that should give you a little context there. Of course, crude oil, despite the rally, did not rally, and you can see during the pullback, it actually is rising. So it kind of shows you again how bearish are we over the last couple of days here from a risk appetite standpoint. The dollar's up, long-term bonds up, gold is down a little. Stocks are down 6% or so. But you can see emerging markets are outpacing. Small cap stocks are down. Real estate's down, but they had that big gain. Crude oil is actually up. So maybe we're not as bearish again as we think we are when you dial this back a little bit. In fact, again, how I told you before in my last market outlook about the importance of crude oil holding its floor, right, and not falling through its floor. Well, after getting that cluster, now it's trying to figure out what it can do. In fact, you've got a little bit of a bullish divergence showing up here on the near-term line. You can see that here. Bullish divergence with the higher lows and obviously much lower lows at the end of its extended run. One good sign that things are starting to potentially reverse in that regard. Again, we don't need crude oil to go up. It doesn't have to go up more than equities, but it should at least not fall through the floor. And you can see if I look at like these common oscillators, RSI and CCI, they're still extreme. We're still below 30, which is so hard to do, but it's been that way, and it's been diverging below 30, and CCI obviously also diverging below, after getting below negative 200. So there's a really good opportunity for this to run up, for crude oil to run back up, at least USO to run back up to 35. If it does, that's actually going to be relatively bullish for equities. Again, we don't need crude oil to go up, but if it does go up, that's a sign of risk appetite, right? Generally speaking, it's also a sign of like extreme inflation, and that's not the case right now. So it'd be more of a sign of risk appetite and demand for that. So again, nobody's talking about that kind of move happening. So that's a very low probability scenario. Everybody and their dog out there is talking about how bearish crude oil is. But you can kind of see that the worst of the selling has occurred, and now we're just kind of grinding. And when you're getting to a grinding, diverging level, it makes it really easy for a move to the upside to come out of nowhere with whatever catalyst nobody knows about yet, because they're not pricing it in yet. So that's what's going on there. Another interesting development from an asset class standpoint is the strength in the dollar. That little bounce in the dollar that we had that I showed you put some pressure on gold prices. Oh, sorry, I wanted to show you this. The market forecast on the dollar. And again, the equities are bullish when the dollars are bearish, right? Generally speaking. Well, here's our little bounce, and that's really all the bounce that we're getting. You can see we're getting long lower shadows. So that's really not the best bounce that you want to trust with long-term market sentiment, which had been rising during this time, starting to roll over. The question is, is that a bounce that's going to lead us back to the old highs or to new highs? Most likely not, right? There's a pretty good chance that this is just a short-term bounce and a rollover. And again, that would also lead to an increase in risk appetite. So that's something to keep an eye on. With yields as low as they are, you can see TLT has been bullish and it's slowing down its ascent. Is still relatively strongly bullish. So its upsides, its upside's more limited because it's experienced most of its upside. It's 2 standard deviations right now away from its linear regression. So that means it doesn't mean it doesn't have any upside. It just means it has limited upside. Especially the 10-year yield. So TLT is not 10 years, it's 20 to 30, but the 10-year yield, you can see how extremely low it is. Even on a 10-year basis, so extremely low here. And you got this big long low, big ace piercing line candlestick pattern on a weekly basis. You can see that we're just trading within the range of that right now, slowly, and again with a good margin of safety. And if yields rally and crude oil rally, then you have an opportunity for a pretty decent run to the upside. from a sector standpoint, to kind of get an idea of how today performed here, let's take a look at the sector performance. Let's come over here to this chart, and this was an interesting that I tweeted out about this. If you take a look from again that same 323 low point that we had, this rally that we had into the close on Monday, this Monday. Let me look at utilities were up 28% in 5 days, right? And real estate was up. These REITs were up 25% in 5 days. The market itself was up 15, 17%. The S&P eventually getting up at Tuesday's high point of about 18% off of that March 23rd close. That's a really good run in a short amount of time, and that's really good returns for these quote-unquote safety sectors in a short amount of time. Yeah, they've fallen the most these last couple of days, and there's a lot of reasons why. But I think one of the easiest and biggest reasons why is they had the biggest room to fall. Like during this rally, we've talked about that. During the rally, we didn't have these cyclical areas down here leading a rally. Technology, discretionary, even staples, both consumer sectors, and then these communication services. They lagged during the rally. So now that we are falling, in fact, even through the ups and this 2-day down, utilities is still the second best performer during this whole 7-day run. Still the still the second best performer. Energy has kind of held up here as remember crude oil has rallied during these last couple of days. And then you can see real estate is actually the third, or just barely the fourth best, just right behind industrials for the fourth best return, despite this 2-day drop, because it had such a big rally in 5 days. That's not normal, and so it's given some of that back during this pullback. And so again, this is what it looks like during the pullback here. From the 331 pullback, there's energy, but now look at communication services, look at staples. Healthcare obviously is doing well from a relative standpoint, and then there's technology and discretionary outpacing financials and real estates and utility. I mean, these are all the companies that are worried about their dividends, right? That's the biggest reason why they're dropping. But remember, again, 2 days ago, obviously that wasn't such a big concern because they had such a big rally going up. So I don't think that this is anything new. I think the catalyst is the potential cutting of dividends, and that's not a shock. I mean, everybody's been expecting over the last week. I mean, Brandon's been talking about the possibility of them cutting dividends for the last week or two. So it's not a surprise today or yesterday in the last 2 days that all of a sudden some of these places are cutting dividends. And yet still with that potential out there, they rallied up so much in the previous 5 days. So the catalyst was that those headlines for these outperforming sectors to get back some of their gains. Not so much financials, but especially those other two. And that's what you're seeing right now. And again, if that's the biggest losers during a pullback, as I've mentioned to you before, and if you go all the way back here to January 26th, of when I think the bear market started in equities, all the way back here, and you can see we're pretty volatile through that first part of 18, really bad Q4 at the end of 18. By the time we got to this October low point, which is a market sentiment low for pretty much everything else risk related, during that whole time, about a year and a half or 2 years, almost 2 years, and utilities were up 25% and real estate were up 25%. And they had been doing really well, outpacing technology and discretionary. You don't see communication services on here because it wasn't, it's a relatively recent change. But those FANG stocks led us up. Everything else was down, right? I mean, look at all these other cyclical areas, materials, industrials, financials, energy. We're all down at that October, after that bottom. And then they lagged behind, and of course we're dropping here. But going into this drop, you had the two biggest outperforming sectors. 2 of the 3 biggest outperforming sectors were utilities and real estate going into this steep decline. So there's going to be opportunity for whatever reason for those typically high yielding sectors to underperform. And the type of scenario where they underperform for an extended period of time is usually a bullish risk appetite scenario. So who knows when that's going to start, or when it will start, when that underperformance will start. But that's just something to keep in mind, that long-term underperformance in those sectors, and again, everything's cyclical. We've just had this was a 2-year outperformance in those sectors. So now, going into, if you look back 2 years going into that January 26th peak, they were hardly outperformers, right? So you come into 2016, here's our 2-year returns going into those peaks, and they were big time underperformers. You don't see real estate here because, again, of a change and how it worked. But look at the cyclical areas going into that peak. That's what we had going into that January 26th peak. Very excessive, excessive risk taking here, according to the sector rotation. And of course, since then, it looks like we've been in a bear market, right? It looks like we've been here in a bear market. That's not surprising when you see the returns like this. And so again, when we go back to a return, a long-term return of a rotation of those underperforming, is typically a bullish. And considering that everything is pulled back now, I don't think it will be too long, because it's not like we've been, you go back 10 years ago to see how some of these have been performing for the last 10 years. They're still pretty high numbers. Like, technology is still pretty strong, on a 10-year. We do show the performance. So 231% return still over the last 10 years, even with this decline. So any like bounce we get in risk appetite won't be like another 10-year bounce like this, because we're still very elevated in terms of risk appetite. I don't think this means that we're going to continue to drop off a cliff. I just mean that we're going to expect a decent bounce in risk taking until we get some of these safe haven areas more oversold, because they're so unbelievably overbought right now. Then you'll start to see that kind of real bear market, where instead of dropping 30% in 4 weeks because of a crazy one-off coronavirus thing, it'll be more of an extended bear market that will drop 34-35% over multiple years. That won't all happen at once. It will happen gradually and then finish all at once. But like we saw in 07 to 08 and beginning of 09, like we saw from 2000 to 2003, where it was more of a gradual multi-year bear market that finished with 30% plus all the way to 50 declines, instead of all in 4 weeks, essentially like we saw in 1987. All right, now let's take a look at our trade idea of the day. So our stock that we did our trade, you can see here, is on Home Depot. Home Depot, hit that moving average and rolled over, and is really bearish, and it's kind of got a high, as I mentioned, this expectation that we might bounce in the next day or two. The reality is the high probability trade is a rollover to the downside, right? And you can definitely see it in stocks like Home Depot. We got the rollover. The MACD is rolling over. We're below the moving average. You take a look at its market forecast chart, and you can see, we got dark pink shading again because we're rolling over on the market sentiment's got a lot more room to fall to the downside. You look at its 3 green arrow chart. You can see we basically held the 17-day moving average for resistance, got back below the 8-day. The MACD is rolling back over. The stochastics looks like it might roll over from a phantom green arrow. You take a look at its DMI. It looks just very similar to the market itself. You can see it bounced back up above 25. It's negative directional, positive directional index, bounced back down below 20. I don't expect a big extended run to the downside, but as you saw in the Bollinger Bands, not a lot of room, not a lot of volume support below where we're at right now. If you go all the way out to a 5-year chart, you can see there's room to fall down towards 155. And if you look at like the Ichimoku cloud, this little bounce that we had reduced the strength of the bearish trend, but didn't get rid of it. In fact, we held the blue line and rolled back over, and potentially could fall back below the green line and fill in that gap right there that we had on 326 or 324 essentially, since we're already to that gap. Now the S&P has got room to fall down to that gap, where the HT is already below that. So So we've talked about in our classes, in the directional options class, about how do you do short verticals in here, and especially short call verticals, which are so hard to do and very risky trades, because bearish moves. Well, here's a high probability bearish setup because we hit resistance, a lower high, and we're rolling over, and we've already got the rollover. And so again, if we rally up, we've got room to work with a short vertical out towards these 195, 190 area. And if it holds and we roll over, then we can make a quick move to the downside. So, and that's what we did actually. We went to the trade tab and we sold the 190 call and bought the 195 call. So we sold right around that 30-40 delta. We ended up, here, let's get rid of this one here. We ended up with a normal position size, because again, the idea is if we can get half of this max gain really quickly, if we can drop to 160 within the next couple of days, if the market doesn't bounce, and we just drop, if we can get towards 160 in the next couple of days and get half of that max gain really, really quickly, we'll take it. Because see how fast we get the first 50% and how slow it gets to the other 50%. So if we can get the first 50% and start and change it to something else that also might be rolling over and showing us high probability bearish setup, then we'll keep doing these. And if we don't roll over and we bounce up for a couple of days, for us to get to a $570 loss, which is where as much as I'm willing to lose whenever I'm, what I'm trying to make, then it can go all the way up to 214, which is highly unlikely. Like for it to get all the way up to 214 is way up here. I mean, we'd have to break through these highs. I can see us bouncing back up to these highs. I don't see us breaking necessarily through those highs. On a lot of volume resistance up here, right? On the Bollinger Bands, if you recall. Let me go back to the Bollinger Bands here. A lot of volume resistance. So we have so it's unlikely to get all the way up to 214, but it could get back up into this area. And if it did, I might be down a couple $100, but that's okay. But if we continue down really quickly, down towards 160, about where my cursor is, boom, I take those gains, I get out, might be in a day or two is all it takes. And that's how bear call verticals work. I mean, you can get your 50% max gains really, really quickly on these, and because they're such hard trades to do. So we'll take it, because we can go up and down really quickly, and it's really hard to run those vertical spreads all the way to expiration. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It takes you to our Market Outlook forums. You can open up any new questions or comments there, any new thread with questions or comments about what we talked about in the video today. You can also reply to anybody else's comments, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video down below. Follow me on Twitter for more content between the videos, and join our community at marketscholars.com, as I showed you before, as well as our Facebook group that we've created. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.